All right, so chapter 14, bonds and long-term notes. So there's different ways that companies can um, finance their operations, especially as it relates to capital improvements and big additions, big projects, big equipment and manufacturing facility purchases. Of course, they could do it internally. Um, they could, to the extent that they can earn profit, they could take those excess profits and uh, finance long-term operations. But most companies don't have enough internally generated cash flow to um, finance the large operations, uh, just the day-to-day operations. So many times they have to go outside of their own operations in order to finance these long-term projects. So external sources would be uh, such things as debt, which we will talk about here in a minute. Debt as in bonds, debt as in notes payable are the most prevalent. The other way that they could finance operations is through selling stock. So that would be equity. So what we're going to talk about in chapter 14 is debt. And if you recall, we present the value of a liability as the present value of its related cash flows. And if you recall, we have a principal amount as well as an interest component. And so essentially what you have is if you recall, in the chapter 6 presentation, what you have here essentially is two components, uh, cash flow components. The interest payments are annuity payments, meaning they are a fixed amount each period. And the other part, the principal amount owed, is the amount that is going to be paid in the future. Now, again, there may be principal and interest paid uh, as different components of a payment, or in the case of bonds, it might be uh, the case of a present value of one, where the payment of principal doesn't happen until the end of the maturity date. And so it's kind of like a balloon note. And recall that we value the liability at its discounted or effective rate of interest at the time of issuance. All right, so talking about bonds, um, the corporation who issues the bond is obligated to pay two things. The interest they're obligated to pay at certain intervals. Most commonly, that interval is um, every 6 months. And then they're also obligated to repay the maturity at maturity the face amount of the bond. And most of these bonds are in denominations of $1,000 each. Um, some other names for the face amount are principal, par value, stated amount, or maturity value. Other names for periodic interest are stated rate, coupon rate, or nominal rate. um, when these bonds are issued, the issuing corporation uh, designates a trustee, which is usually like a bank or a brokerage firm. And what that trustee does, especially if you have like several buyers of these bonds, it would be very difficult to um, have a formal agreement with all of your bondholders if there are several of them. And so what happens is that the issuing corporation uh, issues to the trustee, the brokerage firm or bank, what's called the bond indenture, which is the legal document, if you will, or the legal instrument that spells out both parties, the bondholders and the bond issuers, obligations and rights. And so this bond indenture describes the specific promises that are made to the bondholders, and the trustee holds this indenture, and if the company fails to live to the terms of the bond indenture, then the trustee may bring legal action against the company in the name of the bondholders. Now, most of these bonds are what's called debenture bonds, meaning that they are unsecured. The only thing that's securing these bonds is what they call the full faith and credit of the company, meaning the bondholders are hoping that because of the credit standing of the corporation, the issuing corporation, that they will be paid back. But these are unsecured bonds. So no specific assets are pledged as security, and they have the same standing in the case of default as a general unsecured creditor. So they're usually left holding the bag just like other unsecured creditors. There are some other types of bonds, but most bonds are debenture bonds. But you could have a mortgage bond. That would be one that's backed by a lien on specific real estate. And because there's less risk involved, since there's a security interest in specific property, these tend to pay less interest. You could have a convertible bond that converts to either preferred or common stock. Now, most bonds are callable, meaning that the company can redeem them at some point in the future. The call price must be pre-specified, and because they want buyers to buy the bonds, they usually have a premium attached to the call feature. And so this premium means that if they call the bonds, which invariably they do, because they don't want to be stuck with uh, let's say a a high interest bond that when interest rates go down, they could call them and pay them off and then issue new bonds at a lower interest rate that they would be required to pay. Um, anyway, when they call them, if if they have this bond premium, they're going to pay more than the face value of the bond when they call them. All right, so question here, which of the following statements is not true concerning types of bonds? So A, a debenture bond is secured only by the full faith and credit of the issuing corporation. That's true. A call feature on a callable or redeemable bond allows the issuer to buy back outstanding bonds at a price to be determined at the call date. That's not true. This call feature has to be spelled out at the time of the issuance of the bond, not at the call date. So B is the correct answer. All right, so the issuing corporation, when they issue bonds, obviously have to recognize a liability. And what they show here is that to the investor, that would be an asset. We're going to focus on the issuing corporation, though, more than anything. But just understand that the issuing corporation's liability is simply the flip side of the investor's asset. All right, so here on January 1, 2018, Masterware Industries issued $700,000 of 12% bonds. Interest of $42,000 is payable semi-annually on June 30th and December 31st. The bonds mature in 3 years. The entire bond issue was sold in a private placement to United Intergroup, Inc. at the face amount. So they simply recognize the cash receipt of $700,000, and so that would be your debit, and your credit would be to bonds payable. So that's your initial entry. And then on June 30th, they're going to recognize interest expense on the interest paid of $42,000, and of course their credit's going to be to cash. Now understand the thing about bonds. A lot of times what you could have is a bond that is at a stated interest rate, but because of the lag in time between the printing of these bonds and their actual issuance, which may be 6 months later or something like that, maybe even longer, the market interest rates may have fluctuated. And so they may be higher or lower than the stated interest rate listed on the bond. And so the problem there, when the market rate is different than the stated rate of the bond, is you have to make these bonds attractive to potential sellers. Especially the case when the stated rate on the bond is less than the market rate. And so when you have that situation, you have to what they call discount the price of the bond to make the returns on the bond desirable to potential investors. And so you won't see very many premiums on bonds simply because usually bond price or the market interest rates don't go down below what the stated rate is on the bond. More often what you see, but we'll still talk about it, more often what you see is the fact that market interest rates are above the stated interest on the bonds. And so here in this example, of course, we just looked at an example where the stated interest rate and the market interest rate were the same. So if that's the case, no problem. Very easily we can figure out that this company is going to receive, as we saw, the same amount in cash as they had in bonds. So where the interest rate is the same as the stated interest rate is the same as market, no problem. But where the stated interest rate is less than the market rate, they have to do something to attract investors. That something is called discounting the bond. And so they would discount the bond to where the present value of the cash flows on the bond will equal a return of 14%, as in this example. Now, if perchance there's a situation where the stated interest rate is greater than the market rate, then the potential investors would be clamoring, as in this example, if market rate's at 10 and your bond is providing 12% stated interest rate, then you're going to have lots of demand for buying this bond. And so you can actually demand that potential investors pay a premium for this bond. So they're going to pay more than the face value of the bond. Understand also that bond ratings have a lot to do with the risk on the bond. Thus, the riskier the bond, the higher required return by investors. So, like we talked about early on, the bond price is the present value of the principal payable at maturity plus the present value of the periodic cash interest payments. And so again, the interest payments are like annuities. So, if you were to use the tables, you would go to present value of annuities and figure out the length of time this annuity is paying out, which is the number of periods that interest is being paid, and figure out the present value of the interest payments. And then the principal amount would be present value of 1, because what you're doing is you're paying a lump sum on the maturity date. And again, the the rate of return you're going to use, the required rate of return you're going to use when figuring out the present value is not the stated rate of the bond, but it's discounted at the market rate. Understand also that these bonds are quoted on uh, stock exchanges or exchanges much like stock. And so, and once they're out there, once they're issued, they actually have a secondary market where investors can sell the bonds to other investors, just like the secondary market in stock. And these bonds, when they're sold on the secondary market, you'll see in the exchanges that their prices are quoted as a percentage of the denomination of the bond. So, for example, if you have a price quote of 98 on a bond of $1,000, which is typical, then you could expect to pay $980 for that bond. And then, of course, if it was 101, it would be 101,000 that you would expect to pay for that bond. All right, so here we have the same example, except here the market yield on bonds of similar risk and maturity at the time of the issuance of this bond to United by Masterware is 14%. Again, the stated amount of the bonds percentage-wise is 12%. And so to make this desirable, Masterware's got to issue these at a discount based upon market yields of 14%. And so to do that, you simply go to the present value tables or Excel, take your pick. And so if we go to the tables for the annuity payment, we're going to multiply 42,000 times 4.76654. Since these are paid semi-annually, this is a bond that interest is payable over 3 years, but since it's semi-annually, there are 6 payment periods. As far as the interest rate, it's going to be 1/2. Every interest payment is going to be 1/2 of the market rate of 14%. So the interest rate is going to be 7%. So again, if you look in your tables at Table 4, present value of an ordinary annuity 1, and you go down to your 6th period, 4.7664 is the number. So just like it is here, you multiply that times 42,000 and you get a present value of the interest payments, 200,195. The principal, you have the face amount of 700,000. Again, n equals 6, I equals 7. You go to the present value of $1, which is table 2. And so if you go to 7%, the sixth period, 0.66634, which is what you see here. Multiply that times the face value of 700,000, you get 466,438. So in this case, what Masterware is getting is they're getting $666,633. The difference between that amount and the $700,000 is what they call the discount on bonds payable. Now what's going to happen is you're going to have to amortize that discount on bonds payable over its period, over the life of the bond, so that the amortized amount at the end of that period is going to be the same as the face value of the bond. And so this discount on bonds payable, which shows on the initial sale as a debit balance, is going to have to be amortized by crediting discount on bonds payable every time there's an interest payment, every 6 months, so that the discount on bonds payable essentially goes away, comes to zero, because you're amortizing it over this 6 period payment. I mean, it's almost like the discount on bonds payable is a contra liability to the bonds payable. And the book value of the bond, meaning the bonds payable minus the discount on bonds payable, as of the issue date, January 1, 2018, is 666,633. But what's going to happen is every 6 months, you're going to reduce the discount on bonds payable so that the book value, the difference between bonds payable and the remaining discount on bonds payable, will keep increasing until in that last period you now have no discount on bonds payable left. All you have is bonds payable at face value of $700,000. So here's your initial entry for the issuer and the investor. Discount on bonds payable is the difference between the cash received, which is less than the face value. And so what you're going to do is you're going to, every 6 months, you're going to take and you're going to calculate this amortization. Now there's a couple of ways to do this. You can use what's called the effective interest method, which you see on page 777 in illustration 14-6, where you're simply going to take the outstanding balance at the time of the calculation to figure out the discount on bond payable that will be the amount of the credit. Okay, so every 6 months, what the company is doing here is they're paying $42,000 in interest, but they're also amortizing the bond discount based upon the effective interest rate, the 7%, times the outstanding balance at the time of the calculation. And so, for instance, uh, the first payment. At the first payment, the outstanding balance is $666,633. They're going to multiply that amount times 7%, the effective interest rate, and they come up with 46,664. And so that amount less the face amount that's going to be paid on the bond in interest is the amount of the discount reduction. So that's your amortization amount. And so every period, and notice in the second interest payment, the outstanding balance has increased by the amount of the discount reduction, 4,664. And so in that second period, you're multiplying 7% times 671,297. And so every period, your discount's being reduced by that calculation. And notice at the end of the sixth period, the outstanding balance is the same as the face amount of the bond, $700,000. Well, that's because the contra liability account, if you will, discount on bonds payable, has been reduced to zero. Okay, so pretty simple calculation. Just realize that you have to use the effective interest rate, which is the market rate, not the stated interest rate. And so every 6 months, what they're going to do is they're going to recognize interest expense of $46,664, so that's the debit. And for that first, well, and again, it changes. So in the first payment, calculating this, it's $46,664 interest expense. So that's your debit. You're paying $42,000 cash, so that's your credit. And you're also crediting discount on bonds payable for $4,664. Now in that second period, 12/31/18, the amount of the interest expense would be $46,991. You'd be crediting a discount on bonds payable for $4,991, and then you would be crediting cash for $42,000. Okay, so that's the way it's going to work. All right, you don't see this very often, but sometimes you'll see bonds sold at a premium. So when market rates are below the stated rate of interest, you're going to have lots of people wanting your bonds, so you can actually sell it for more than the face value. If you have that situation, you're going to use as your market rate, or the required rate of return, you're going to use the market rate again, not the stated rate. And so in this example, the market rate is 10%, and so you're going to and again, this is a little bit of a misnomer. You're going to discount your interest and principal amount at the market rate of 10%, not the stated rate of 12%. And so again, if you go to the tables, you go to 5% for 6 periods, and you get, again, same tables for interest, 5.07569, and same table for principal, 0.074622. And here we're selling the bonds at a premium of $735,533. Now here, this entry, we're going to have excess amounts, and so we receive cash over the face value of the bond, and the difference is a credit, not a debit, like with discount. We have a credit called premium on bonds payable. And so here what we're going to have to do, we're going to have, well, the book value of the bond is the amount of the bonds payable plus the premium. So 735,533. And so this premium is going to have to be reduced each period, just like we saw the other, the discount. But here what you're doing is not increasing the book value of the bond, you're reducing the book value of the bond. And so you're amortizing, almost like negative amortization is what you've got going on here. And so again, you're using as your effective interest rate the market rate, and again, it's 1/2 of 10%, so 5%. So again, the same sort of situation. You take the outstanding balance, multiply it times the effective interest rate, here 1/2, since paid semi-annually. And so the difference here between the effective interest and the cash interest is $5,223 in this first payment. And so you're actually going to have a situation where you're paying, or you're going to have interest expense that's less than the cash interest. And so they don't show it, but what you're going to have is you're going to have interest expense of $36,777. You're also going to have a debit to premium on bonds payable. Remember, it's originally initially a credit balance, and so to reduce this, you have to debit premium on bonds payable $5,223, and of course your credit's going to be to cash for $42,000. And you see the rest of the calculations there. So like I say, you almost have like a negative amortization for premium. You're reducing the amount of the premium, whereas you're increasing the amount of, or well, it's kind of hard to explain, but one's kind of like a negative amortization, getting the face value or the book value down to 700,000 from 735, whereas the other is increasing the book value up to 700,000. Not going to go over it, but when you have financial statements that are prepared between interest dates, you simply accrue the amount of uh, the interest that's accrued since the last interest date. So make sure you look at that. You know, we just went through the effective interest method of issuing at premium and discount. Most companies use the straight line method, which you can certainly do. It makes practical sense to do so. And so, for instance, in our example, we issued at a discount of 33,367. In the straight line method, you simply amortize over a straight line the same amount all 6 periods, simply by dividing the 6 periods into 33,367, which is 5,561. So here you would simply credit discount on bonds payable every period for 5,561, and that would be your interest expense. A little bit different, but and the criteria for using straight line method versus the effective interest rate is whether or not there's going to be a material difference between the two numbers that would cause confusion or some sort of misrepresentation to investors and other users. But normally it's not the case. So here, straight line method is an application of the materiality concept by which an appropriate application of GAAP, meaning the effective interest method, can be bypassed for reasons of practical expediency in situations when doing so has no material effect on the results, which it normally does. If you have debt issue costs, you add those to the amount of the amortization. Simple as that. And so here we have an example where you've got an issue cost of 14,000. It would simply increase the amount of the discount, and you would identify it as discount and debt issue costs, and you would simply amortize that over the life of the bond. And so essentially it would increase your amortization amount every period, and of course it would increase the semi-annual effective interest rate. All right, so here we have a question. On June 30th, 2018, Mabry Corporation issued 15 million of its 8% bonds for 13.8 million. The bonds were priced to yield 10%. So we're selling these at a discount. The bonds are dated June 30th, 2018. Interest is payable semi-annually, December 31 and July 1. If the effective interest rate method is used, by how much should the bond discount be reduced for the 6 months ending 12/31/2018? Well, I'll just go ahead and show you. $90,000. Another one, Chisholm Corporation issued 10 million face amount of bonds on January 1, 2018. Bonds have a 10-year term and pay interest semi-annually. The following is a partial bond amortization schedule for the bonds. All right, so question is, what is the interest expense on the bonds in 2019? So essentially, what you've got here is you've got you got the first two payments, which are in 2018. The third payment is in 2019. The fourth payment needs to be calculated, and that will be for 12/31/2019. So the question is, what's the interest expense on the bonds in 2019? Okay, so it's going to be what? Well, let's just see what they say here, how they figured it out. So the semi-annual effective interest rate is 3% based upon that first calculation of 344,632 divided into 11,487,747. And so if you take that 3% and multiply that times 11,316,611, which is the outstanding balance in the middle of 2019, you can calculate the interest for 12/31/19 and add that to your third payment of third effective interest rate amount of 341,261, and so you come up with an amount of 680,759. All right. In class on Monday, we'll talk about long-term notes.